If you're one of those borrowers waiting on the sidelines for interest rates to come down before you think about buying a home, this is for you. You're going to want to watch this to the very end because there are some super insights as to how you can take advantage of this market and insights as to why waiting could actually be more expensive. For you to understand what a mortgage rate is made up of, I want you to think of it basically as being the same as a mortgage-backed security yield. These are securities traded on Wall Street. Mortgage-backed security yields are made up of two components. The first component, the biggest component, is the 10-year Treasury yield. And then on top of that, we add something called mortgage spread, so that your mortgage security yield is equal to the sum of those two parts. It's important to understand that about 60% of the Treasury yield is influenced by the Federal Reserve's actions, and 100% of the mortgage spread is influenced by investment activity solely in mortgage-backed securities. What's really important to know is that 0% can be influenced by you, at least what the current interest rates are. So there's no reason for you to think that there's anything that you can do to bring down interest rates, but we can do things to reduce your interest rate. Stick around to the end and I'll show you how. Why is this important? Why are we getting into this? Because Fannie Mae and Freddie Mac have been instructed by the current administration to buy $200 billion of mortgage-backed securities. And what that has done is that it has reduced those spreads. And when we have tighter spreads, we have lower interest rates. Back in October of 2023, mortgage rates were about 7.75%. That's because Treasury yields were a little bit higher, but mortgage spreads were much higher. 2.9% back then versus today we're about 2%. You can see here that a large contributor to the rate you get today is tied in with this mortgage spread. But what you have to remember is it is only $200 billion. That's a lot, but it's finite. As Fannie Mae and Freddie Mac buy through those securities, you will see spreads rising up. It's possible that we could see mortgage rates up by 0.4% if nothing else changes with Treasury yields, which is, of course, highly unlikely. If we see yields going up and spreads going up, that's going to be a double whammy for mortgages. Right now, it is more important than ever to understand that if you can afford to buy your home today, to take action and buy today. Because if rates go up in the future, which is conceivable, that you are going to be okay because you've bought a home that you can afford, that you want to live in today, in a neighborhood that you want to live, make friends, and send your kids to school. This is the most important factor that you can control. My name is Patrick Gallagher. I'm the founder of Exhale Lending. If you want to understand how to take advantage of this market right now, DM me the word approved. I'll walk you through your options and help you build a plan that actually makes sense.